Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market5. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Dr. Mikhail Melnik on the line. He's a Bloomberg economist. Dr. Melnik, how you doing on this Friday morning?
I'm trying to wake up.
Okay. All right. So you listened to her speech yesterday, and she kind of gave a little relief to the market, saying, yeah, rates are going to go up in October or December. Are you buying it?
Well, you will probably be appalled by what I'm about to say, so I'm hoping that you're sitting down. I never listened to Yellen's speeches,
Okay.
or those of any of the FOMC members. I haven't listened to the Bernanke speeches also. The only Federal Reserve chair that I do listen to, or I did listen to, rather carefully, was Alan Greenspan, whom I actually greatly respect as an economist and who I believe was one of the best Federal Reserve chairs in the history of the Federal Reserve. Now, why did I say what I just said? Why did I confess to this? Because now you probably will never invite me again because you'll say, well, why listen to the guy? Well,
You're
you know
my
what I mean.
favorite economist.
Why would I confess to my own ignorance of perhaps the most important person on the planet, Janet Yellen, right? Because he's in charge of the most important currency on this planet. So when I was a kid, I read Tolstoy, War and Peace. I was 15 when I read it for the first time. And I was very disappointed with Tolstoy, the philosopher. I was captivated by the Tolstoy, the writer, but not Tolstoy, the philosopher, because he made this argument that history is not made by the individuals, it's made by the masses. And when I reread Tolstoy later on in life, I realized what an idiot I had been and what a genius Tolstoy was. The same logic applies to the Fed. It's not the policymakers who make the policy, it's the economy that dictates it. And a year ago on your show, almost a year ago, in October of last year, I said there won't be any interest rate increases until 2016. I also said the same thing, not on your show, but in my other appearances, 2 years ago, 3 years ago, 4 years ago. In fact, I've been saying that since 2012. So that was based on the economy. So if you had listened to all the speeches made by the various FOMC members, you would have bet on a rate increase so many times by now, and you would have been burned. Basically, it's the economy that dictates the need for a rate increase. It's not the Federal Reserve. In fact, the Federal Reserve has done a good job by postponing it. So the Federal Reserve has done pretty much everything correctly except for their communications with the markets. Let me quote somebody else from my earlier years. In 1995, 20 years ago, can you believe that? I was a PhD student at Boston University. And the professor who taught us the sequence of macroeconomics, the topic related to today, told us in the very first semester, it was a 2-semester sequence, told us in the very first semester that as economists, we should always begin our answers by saying it depends. Because it always depends. And I think that the current FOMC members have managed to learn that lesson very well, because in the same speech, they managed to assure the market that there is no interest rate hike coming, and they also convinced the market that one is indeed coming. So they managed to deliver both messages in one speech and successfully confused the market. And so it's kind of funny to watch the market respond to the Federal Reserve instead of the economy. But since we're on the topic of the interest rates, let me kind of add one more thing here. I continue to believe that the likelihood of an interest rate increase this year is relatively low. The global economy allows the Fed to continue with this loose monetary policy. There is no real inflationary pressure. The commodity market is softened. The growth in China is expected is slowing down. So the global economy allows the Fed to continue to remain loose with its monetary policy. However, I'll probably surprise you again today. And that is, if I were in charge of the Federal Reserve today, in other words, if somebody were to make that mistake and put someone who never listens to any FOMC speeches into the Federal Reserve, I would probably raise the rates in December by a quarter of a percentage point, and one more time before the start of next summer to bring the federal funds rate to 0.5% by next summer, even though the economy doesn't call for it. But the irony is that a rate increase at this time might actually do more good than the status quo. So, if you have any questions, I can obviously address them, but that would be my take on things. So if I were to be in charge of the policy, I would probably start orienting towards a rate increase, even though if you look at the economy, we have a lot of problematic things. The GDP numbers today were very strong. The revision to the third quarter was very strong across the board. But at the same time, we have a labor force that is 1 million less than it was a year ago. This time, labor force participation rate is lower by, not labor force participation, but the labor force is lower by 1 million workers. So we still have this sluggish labor market. We still have sluggish inflation. I think Yellen was correct. I read this on Bloomberg. I didn't listen to the speech, but I read it on the Bloomberg website. She was correct that inflationary expectations in inflation itself will stabilize around 2% within 2-3 years. She was right on that. I said that last month on your show, and I believe that's a correct assessment in this situation. But the U.S. economy is getting to its new equilibrium, and all the characteristics are already in place, and I think at the end of this year we'll make the nice transition into that new equilibrium. Things are starting to stabilize towards that. And I think the U.S. at this time could benefit from a flatter yield curve than from a steeper one like the one we have today. And ironically, to flatten the yield curve, I think the best course of action would be to raise the federal funds rate a little bit. I'm not talking about major increases, that can't happen, but something to bring it to 0.5%, because that would actually flatten the yield curve and lower the long-term rate structure. Ironically, a small rate increase might actually lower the 30-year, the 20-year, and potentially even the 10-year yields. And that is something that certain markets in our economy, including the housing market, including corporate debt, including the U.S. Treasury debt, might benefit from. So there is a potential from that angle. And also, do we really need a steep yield curve at this time? Who are the primary beneficiaries of that? Well, that includes banks, insurance companies, and people who are about to retire. I'll ignore the last category and focus on just the first two, in fact, the first one. Our banks probably might benefit from a rate increase purely because the Federal Reserve has tied interest payments to the federal funds rate, the interest payments on required reserves and excess reserve balances of banks. If we see a 0.25% increase in the federal funds rate, given the current policy standing and given the current level of reserves, that would amount to above $7 billion a year, to an increase of over $7 billion a year in money printing. So, ironically, a rise in the federal funds rate today will actually contribute to money printing. It's just the allocation of money printing will be different. So, certain parts of the economy will feel the pain, like, for example, the stock market. A rate increase would actually pump liquidity out of the short-term debt, out of short-term corporate paper, and that will hurt the stock market. But since so far this year, the stock market has had such a spectacular return of a negative, 3 or 4%, it's kind of difficult to say that it's set up for a big correction, because it's difficult to say that the bubble has continued to inflate this year. So that's basically how the outlook is starting to look. So the person who's been calling for no rate increases until 2016 for now 4 years is saying that if he was in charge of policy, he would start moving upwards at the end of this year or at the beginning of next year.
Okay, thank you very much. We've been on the line with Dr. Mikhail Melnik. He's a Bloomberg economist, joins us here on Benzinga's Pre-Market Prep, giving us his take on interest rates. Thanks for joining us, and we'll talk to you again soon.
Thank you.